Do you remember 2022? The year markets felt like they were in free fall? Inflation was soaring, interest rates were spiking, and the financial news was a steady stream of doom and gloom. It was one of the most challenging environments for investors in decades, as both stocks and bonds, the two core pillars of any portfolio, were declining simultaneously. This kind of volatility is a true test for any investment strategy, especially for a digital wealth manager like Nutmeg. So, how exactly did Nutmeg's portfolios hold up when the market turbulence was at its peak? The short answer is, diversification was key, but it wasn't a free pass. The volatility challenge. First, it's important to understand the challenge. When markets are volatile, an investor's biggest enemy is often panic. Seeing your portfolio value drop can make you want to sell everything and wait it out, which is usually the worst move you can make. Nutmeg's core philosophy is built on long-term, globally diversified investing. This strategy aims to ride out short-term fluctuations, and for the vast majority of their clients, it worked. Nutmeg saw that over 90% of their clients made no change to their portfolios during the most significant drops, a testament to investors sticking to their long-term plans. Strategy under stress, fully managed versus fixed. Nutmeg offers different portfolio types, and the volatility really highlighted the difference between them. Fully managed portfolios, these are actively adjusted by the Nutmeg investment team in response to market conditions. During periods like 2022, this active approach meant the team could tactically reduce exposure to certain assets or regions that were facing the worst headwinds, attempting to cushion the fall. This forward-looking management is generally quicker to react and has historically shown better recovery times. Fixed allocation portfolios, these portfolios are cheaper, but they are not actively managed. Their asset allocation is set and automatically rebalanced, but they don't adapt to new macroeconomic news. Because of this, when volatility hit, these portfolios sometimes experienced steeper initial drops and were slower to recover than their actively managed counterparts. For example, during the market dips of 2022, it was observed that the fully managed option, across different risk levels, generally experienced a lower maximum fall and showed a faster recovery than the fixed allocation options. The takeaway for investors. Ultimately, market volatility is a completely normal part of investing. Nutmeg's performance during the tough times of 2022 and beyond underscores a few key lessons for all investors. Diversification works. By spreading investments across different regions, sectors, and assets like equities and bonds, losses in one area can be offset by more robust performance elsewhere. Time in the market is crucial. Trying to time the market by selling low and buying high is a losing game. The data shows that patient investors who simply stayed the course were best positioned to benefit when the market eventually began its recovery. The right strategy matters. Your choice between a fully managed approach and a fixed allocation is amplified during extreme market stress. The active adjustments of the fully managed portfolio can offer a buffer that is worth the extra fee for some investors. If you're invested for the long term, volatility isn't a reason to panic, but a reminder to check if your risk level and strategy are still aligned with your financial goals. With that said, thanks for watching, and until next time.